Hey, it's Paul. It's August 31st, 2022, and it's time for another weekly update. As you know, what we try to do on this show is take what's going on in the global macro environment and apply that to asset prices and valuations in the residential and commercial services space. And as I've said for a long time, valuations in the publicly traded markets, so valuations for public equities, can really help to inform us as to valuations in the private markets, which is where you and I spend the majority of our time. And there's been a lot of events in the last couple of days that I think will have a meaningful impact on asset prices in resi and commercial services. And before we talk about those specific events, I wanted to go back a little bit here for context. As we all know, central banks around the world have been attempting to fight inflation here over the last year, raising interest rates, trying to roll off assets from the balance sheet, otherwise referred to as quantitative tightening, and otherwise jawboning markets in order to push down asset prices. Just last August, Fed Chair Powell at Jackson Hole, Wyoming, said to us that inflation was in fact transitory.
Current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time.
Of course, this year, his speech was dramatically different.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
Powell said the Fed was unfortunately going to have to inflict pain on business and households as they force down asset prices and as they continue to either increase or maintain higher interest rates for longer than the market expects. Bottom line, he was saying there will be no Fed pivot. We are serious about this, and our number one job is price stability, and that is to get rid of inflation and get it back down to our target of 2%.
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
When Powell came out and had that discussion on Friday, of course, the market rolled over. I think the NASDAQ lost almost 4%, or maybe more than 4% on Friday. And we've seen high volatility and we've seen declining markets since then. But starting tomorrow, September 1st, the Fed will engage in a broad, large-scale quantitative tightening to the tune of $95 billion per month. So starting tomorrow, the Fed is getting rid of $95 billion in assets. And watching this play out, I think from an asset price perspective, reminds me of one of my favorite Seinfeld episodes. George Costanza, he was a fat loser, had no job, lived at home with his parents, bald. He sits down with Elaine and Jerry at the cafe and says,
"Every decision I've ever made in my entire life has been wrong."
Jerry says, "Well, listen, if all of your instincts have been wrong, then you need to do the exact opposite."
I should do the opposite.
If every instinct you have is wrong, then the opposite would have to be right.
He does the opposite. He gets the girl, he gets a job, and he lives a great life. And, it makes me think about what's been going on in the broader economy, right? If 15 plus years of declining yields and massive quantitative easing or asset purchases have been wonderful for the stock market, pushing us to like 5,000-year highs, isn't quantitative tightening and higher interest rates the exact opposite bad?
Yes. I will do the opposite.
I think why this is important is, as I've discussed before, when the market begins to turn over, a lot of that has to do with the contraction of multiples. So transaction multiples begin to contract, and we've seen that. We saw the big spike in Q4. We're slowly starting to see them contract. In addition to the contraction of purchase price multiples, you have to think about, like, in a PE multiple, the denominator on the bottom is the earnings. And of course, what goes on in the broader economy with regard to earnings is extremely important to valuations. And I think right now in August, I'm really beginning to see the impact of increased input costs. So inflationary pressures from our clients on their P&Ls. I'm seeing the impacts of wages, of increased fuel cost, of increased supplies. And that's putting pressure on margins. We're seeing margin contraction. So when you think about like a PE multiple, not only if you have the multiple contract, so acquirers are willing to pay less dollars per dollar of earning in purchase price, and then we see the E begin to compress, it's a real double whammy. And I think this is particularly evident in the public market. So let's take a look at 30 plus years of S&P 500 history. And we can look at the operating margins. And if we look at 30 plus years of S&P 500 history, the operating margins in the last few quarters have been the highest they've been in decades. You can't see any higher operating margins than you do over the last few months here. We're beginning to see the start of this recession, the recessionary impacts. So I think there's going to be a lot of downward pressure on valuations. But I can't help but looking at this operating margin chart saying to myself, if we are going from operating margins at all-time highs into recessionary operating margins, I mean, we could potentially see a dramatic collapse in valuations over the next 6 to 12 months, which is what I fully expect to see. So in closing today, we had a Federal Reserve chairman come out last week and say there will be no pivot. Interest rates are staying higher for longer. We're going all in on this. We're going to inflict pain on households and businesses. We've got margin contraction that is just beginning. I'm just beginning to see evidence of that in our clients. And we've got the S&P 500 and all these private resi and commercial services businesses running at historic high operating margins. We've seen multiples begin to contract over the course of 2022. And I expect, given quantitative tightening that's commencing tomorrow on a very broad scale, we'll see further multiple contraction over the next 6 to 12 months. And then the natural inflationary pressures will begin to take hold on private company and public company P&L. So keep all of this in mind as you plan for your exit. If you want to chat with us, please reach out to Potomac. Thank you for joining me today.
My name is George. I'm unemployed and I live with my parents.